How beginners profit from massive market crash. If stocks don't fall, the Fed needs to force them, according to a Bloomberg piece published a month before the Fed raised rates. That was a warning sign that inexperienced investors should have heeded, but meme stocks had gained so much money that they seemed unstoppable. Making money is simple when everything is going up. Whatever your purchase will be a wise investment. You will profit regardless of which stock you purchase. Of course, it's fantastic, but in the long run, it's quite risky. You'll begin to believe that reading financial statements and examining their long-term plan aren't vital factors to consider when picking which stock to purchase. Here it is. You made money even though you had no idea how to read financial statements. Your confidence would be shaky, as it would not be founded on firm footing. That's why most meme stock investors lost money when the market plummeted on May 4th, when the Fed raised rates by half a percentage point. When these meme traders' portfolios have lost more than half of their value, they will most likely move on to something else and quit trading or investing until the next boom. The only issue is that the next boom does not appear to be imminent. Inflation has been so out of control that it is now the Federal Reserve's top priority. The Economist Intelligence Unit expects the Fed to raise rates 7 times in 2022 to 2.9% in early 2023, according to experts. Furthermore, the Fed intends to drastically reduce its $9 trillion asset portfolio purchased during the epidemic. After a slower start, the Fed plans to start shrinking the balance sheet in June at a maximum monthly rate of $60 billion in treasuries and $35 billion in mortgage-backed securities. This may not seem significant, but it was one of the primary causes for the market's reaction. Bond purchases are one of the main ways the Fed injects money into the economy. When bonds reach maturity, the Fed frequently replaces them or utilizes the interest to buy fresh bonds. However, it will no longer renew them, implying that there will be no more cheap money in the economy. Of course, it won't happen quickly, but rather gradually so as not to create any imminent economic collapses. But it has already done so, sending a clear message to investors that the era of cheap money is over. That's why equities and cryptocurrency plummeted to new lows. But it begs the question, how can you profit from a crash? Is it possible to make money when the market is down? We'll address all of these questions and more. But before that, give this video a thumbs up and please note that this is not financial advice and everything discussed in this video is for educational and entertaining purposes only. When we talk of a crash, we usually mean something bad. Emotions take over and you begin to sell positions that are falling faster than a collapsing jet. It's much worse when these assets account for all of your savings. Consider the situation of GameStop, where people were ecstatic and invested everything they had into the opportunity. Things, unfortunately, went wrong. After the hedge fund's deception, people panicked and sold their investments at a loss of 80%. They would not have lost as much if they had been a little more patient. Of course, it's easy to speculate about how things should have gone after the fact, but unfortunately, it is the nature of the market. We'll be able to say the same thing about the 2020 crash. The moral of the story is that the best thing you can do for your finances is to avoid allowing emotions to influence your investment decisions. Each time the market overreacted and fell precipitously, it quickly rebounded. Others who rushed and sold out later regretted their decision, while those who were patient were rewarded. The S&P 500 index dropped more than 4% after the Japanese attack on Pearl Harbor, then dropped another 14% over the next several months. After that, and until the conclusion of the war in 1945, the stock market averaged a return of more than 25% every year. The moral of the story is that it is best to buy while everyone else is panicked and selling. People will begin investing again once everyone has calmed down and realized that life goes on, regardless of what occurs, bringing the market back to its pre-crash level. Put or call options are another technique for investors or traders to profit from a market catastrophe. Return with me to April 2022. The markets were performing admirably. The only difficulty was that most people were unsure whether or not the Fed would hike rates in May, and if so, how the market would respond. You could have shorted the market if you were 100% convinced, but if you aren't, you have another alternative: option to put. For a modest cost, you can sell the shares for a certain price. Let's say stock A is worth $100, and you believe it would drop by more than 50% if the Fed boosts rates. You purchase a $5 put option to sell stock A for $100 with a month's expiration. You have 30 days to take advantage of the choice. If the stock does not crash, the most you can lose is the $5 you invested. However, if the market crashes after the Fed hikes interest rates, and stock A falls 50% to $50 as you predicted, since you have purchased the right to do so, you can buy the stock for $50 and sell it for $100. And presto, you've just made $50. You have a profit of $45. After deducting the cost of your put options, which was $5, you have a profit of $45. This is one of the most common techniques for traders to profit from crashes while minimizing their risk. However, suppose the market has plummeted and you are unsure whether it will return, so you do not want to risk your money by purchasing stocks. Is there any way to profit from this downturn? Obviously. We have call alternatives because of this. A call option functions similarly to a put option, except that you have the opportunity to buy the stock at a set price. Let's assume Company B has dropped from $80 to $50, but you believe it is only a short dip and that the company has everything in place to rebound to $80, but you're not sure. We could be in for a recession, and the stock market could continue to fall. Instead, you purchase a call option, which gives you the right to buy the stock at $50 for $5. The stock returns to $80 2 weeks later. You exercise your right to acquire the stock for $50 and subsequently sell it for $80 on the open market. You made $25 on this deal after deducting the cost of the call option, which was $5. As a result, not everyone suffers in a market crash. During a crash, some people thrive. Some others are even willing to risk everything by shorting the market. That's why we're hearing stories like this one. Tesla short sellers have profited $8.2 billion betting on Elon Musk's company this year while tech stocks have plummeted. Instead of buying put options, you could borrow the stock from your broker and sell it on the open market for, say, $1,000. Then purchase it back after the price drops to, say, $700 and return it to your broker, pocketing the $300 difference. The sole disadvantage of this method is that the stock price can theoretically grow indefinitely, resulting in unlimited losses. That's exactly what happened when hedge funds bet against GameStop. Good for them for surviving the disaster, but it might have been far worse, with entire hedge funds going bankrupt. However, as recent news demonstrates, traders are still shorting stocks. Even well-known individuals like Bill Gates employ this method. Gates has been recently chastised for attempting to combat climate change while simultaneously shorting Tesla, which is attempting to make electric cars more accessible. There you have it! What did you think of the video? Let us know in the comments below. Also, make sure to like this video and subscribe to our YouTube channel if you haven't already. Thanks for watching! Have a good one!